Well, I figured since it's the end of the year, we could get into, since our show is finance and technology, I thought I'd kind of give an overview of the last year or so in the markets and how it's related to technology. So just sort of looking through the field of technology stocks and ETFs and mutual funds. So you'll get a kick out of this. The worst performing exchange traded fund. This is just in the technology sector. Any guess on their focus of the fund? Like what type of businesses they invest in? It's pretty specific.
Okay, this is fun. I like this.
Yeah.
Well, I mean, this sounds like a crypto trap, but I'm not. But so this is a technology ETF or an ETF, a technology fund,
Yep. With
and
a narrower focus.
you're
It's in the
asking what
technology category, but a narrower
and
focus.
what narrower focus took a nosedive.
Yeah.
Um, well, not knowing what the categories are, I know social took a beating,
Mm.
and transportation took a beating, especially Tesla stock is down, I think 60% for the year.
Yeah.
So, am I close?
Yeah, you're definitely on the right track, and your guesses are certainly of the top worst performers, but the worst performing. So this is a 1 year number through the end of November. So end of November 2021 through the end of November 2022 is the Simply Volt Cloud and Cybersecurity Fund. Believe it or not,
Wow.
down a whopping 68%. The next two worst performing funds are two ARC funds, which we've talked about before, Kathy Wood and her aggressive allocation. So next generation ETF, which was, kind of metaverse and social. And then her fintech fund was down 65%.
So talk to me about the top one that you mentioned.
Yeah.
Cybersecurity obviously is my my ears perked up when you said cybersecurity.
Mhm.
I can only guess what the brands are that make up that fund. Is it the typical players, McAfee, Symantec, or is it some other smaller outfits or lesser known companies? Does it give you a
It's a
rundown?
little bit lesser known to me. Well, I don't know. It's a pretty good mix. Um, so you've got Palo Alto Networks,
Oh,
Cisco are number 3 and 4,
mhm.
Cloudflare 5. Um, is it pronounced Zscaler?
Okay,
Um, CrowdStrike, VeriSign's a number 9 holding. Just flipping through the stuff I know. Infosys,
okay. One of my
June.
very good friends is a VP or was a VP at Palo Alto. I just saw
Okay.
him at my daughter's birthday party this weekend, and he said that he has tendered his resignation. He's moving on to a startup. So that, I don't
Oh,
know
there
if
you
that
go.
wonder if
I
that's
hope that's
related.
public information. Maybe not.
Ryan, if you're
What else
watching,
we got in here? We got Juniper Networks as a number 17 holding,
okay.
VMware. So those are, but yeah, that composition made up the worst performing ETF over the last 12 months through the end of November. So I thought that'd be interesting to lead off with, since obviously you're a cloud and cybersecurity guy. Um, the two funds that most people think of in terms of, if they want to focus on IT and just general technology. QQQ, they advertise a lot. And that was, if you go back 20, 25 years, that was always the hot day traders, always trading the cubes or the Q, or and that's gone through some symbol changes and some name changes, but QQQ is alive and well, and that represents the stocks that are traded on the Nasdaq.
Right.
So even though it's a technology focus, the weighting, you've got Pepsi as the number 9 holding, so you've got some stuff in there that you might not necessarily think of as being
Do
technology firms, although to
you have any
some
charts you can throw up? Do you have any charts in front of you?
I could. I'll just throw up what I'm looking at here. It's not super exciting. This is
Oh yeah,
pretty
there you go.
raw. Yeah, this is pretty raw Morningstar, deep in the weed stuff. But
All right.
so this is a program I use called Morningstar Direct, which is kind of funny because it's really more of like an institutional level product. There are very few solo advisors, if any, that have this, but I'm just such like a ridiculous data nerd that I almost have to have this. So
I love
um,
it.
But so anyway, so you've got some stuff in there. The other fund people use a lot is the Vanguard Information Technology ETF, and that is more pure technology. So what's important to note on these is the weightings, especially in the Vanguard fund. They're market cap weighted, so the bigger companies are going to make up most of the index, which makes sense, I think, if you're trying to gauge the overall performance of the market, because obviously Apple. So in the Vanguard fund, Apple is 21%, Microsoft is 17%. So those two stocks are making up 40% of the index. So their performance is directly going to have a huge impact on how much this overall ETF trades. And then it drops off significantly from there. Then you got Nvidia, Visa, and MasterCard are only 3 or 4%. So so those market cap weighted indexes, and QQQ is like that too. Its number one holding is Microsoft, number two is Apple, at 12 and 11%. So so those performances are going to be tied to those. So when you hear it's been a rough year for technology, most people are looking at either the QQQ or a technology index, but so much of that is based on the performance of Apple and Microsoft. So Apple last year's down over the last 12 months down 22, and Microsoft down 24%. So
which is pretty good considering the market, right? The market's about down 20%, isn't it?
Yeah, exactly. And then when you say the market, you're talking about the S&P 500, which top two holdings are what? Apple and Microsoft. So
okay, that's your point.
Yeah, so they've been such a big, I mean, obviously not the weightings that they would have in a technology area, but yeah, still pretty big holdings there. But what's interesting is if you start to peel away from your sort of big cap tech funds, and you look at the other fund I'm looking at here is the Invesco S&P Small Cap Information Technology Fund, which is over the last year. So small cap. So it's
Are you looking at a screen? Can you have any visuals you can throw up?
Not really that are going to be that exciting. They won't really translate too well, unfortunately. But so PSCT is a ticker there. Only, I say only, down about 11%. So really the technology that's faltered and the stocks that have faltered has really been at the large end. I mean, obviously Apple and Microsoft, but then you've got performances from Meta, and Amazon's down 50% over the last year. And
well, Amazon's down 50 for the year.
Netflix too. They're down pretty big. So small cap's an area that hasn't necessarily performed as poorly as big cap, because big cap is just, again, pulled down by those larger companies. Another area that's actually positive over, down about 4%, but is like the dividend players. So these are companies that a dividend, just to way back it up, a dividend is when a company earns money, they can do one of two things. They can either reinvest it in their business, through hiring people or for research, or they can take those profits and they can pay them back to shareholders. And if you own the stock, you're a shareholder. So when you receive your dividend, you're getting a share of those companies' profits that they decide to distribute. So typically dividend players, because they're not reinvesting that revenue, the profits back into the business, they're not growing as quickly as ones that don't. So big picture, stock market wise, your dividend players are going to be utilities, they're going to be banks, they're going to be insurance companies who generate a lot of revenue, but they're not necessarily
mature business models.
Yeah, they're not necessarily, investing heavily in technology, although you could make a case that maybe they should be. But so when you're looking at technology players that issue dividends, it's a little bit of a rarity, but you do have some in there. So you got Intel, which pays about a 5% dividend. If you throw Visa in there, they pay a little bit of a dividend. You've got Intel. But overall, these type of companies have performed better than sort of your top heavy. Even though Microsoft pays a dividend, it's only about 1%, and Apple pays a tiny bit of a dividend too. But the companies that have been distributing a share of profits in the technology space have performed better than the ones that haven't. So which is which is pretty par for the course when you got a down market. People are going to look towards income. You're going to look towards that dividend because they view that as, they like getting that dividend every quarter. They like seeing that, deposit in their bank account or in their brokerage account. Whereas another company that might be earning even more money and reinvesting it, you don't necessarily see that as a line item on your statement. So I thought that was kind of interesting. So when people say, well, tech's been beat up, yeah, big tech has been beat up, but small cap has actually done pretty well. And the dividend payers have done pretty well this year too. So.
What's the tax implication of a dividend?
Yeah, so dividends are taxed at a lower rate than capital gains. So if you buy a stock for 100, you sell it for 200, or let's say you sell it for 150, your gain is $50, and there's long-term and short-term capital gains. They want long-term capital gains. They want you to hold your stocks long-term. So those rates are lower. Short-term is ordinary income, and then dividend about 15%, I think, is a dividend rate. So,
but isn't that cap gains? Isn't cap gains at 15?
Short-term cap gain or long-term cap gains. Let's see. Yeah, it's 0 to 20% depending on your income. So, a lot of people like those dividends. They use them in their IRAs and stuff, so they don't have to pay. They're not paying the tax every year because you don't have to pay the dividends inside an IRA or 401k. So.
Tell me about the stock equities compared to treasuries and how that compares in the market profile today.
Yeah, I mean, so one interesting thing that's really happened in the markets over the last 12 months is the rise in treasury rates. So treasuries, in its simple terms, is you are loaning money to the government, and the government is paying you a set interest rate back. So under a normal, we'll say, yield curve, what's going to happen is if you loan the money to the government for 3 months, they're going to pay you a really small interest rate. If you loan the government money for 30 years, they're going to pay you a higher interest rate per year. So that's what's considered a normal yield curve. And it kind of slopes up usually to between 5 and 10 years and then sort of flattens out. But what's happened is short-term rates have really shot up. So now you loan the government money. Well, we'll pull up an actual number here because we'll actually give you some live numbers here. But so if you loan the government money for 6 months, they will pay you 4.7% interest. Whereas if you loan them money for 30 years, they'll pay you 3.7% interest.
That's interesting.
So, yeah, so that's considered a bit of an inverted yield curve because the short-term rates are higher than the long-term rate. So
what does that imply? Is there anything that you can infer from that?
Yeah, usually that a recession's coming. That's usually a sign on an inverted yield curve. But what that also does is so when we talked about the dividend players, people are looking at, people who wanted that income. They might say, well, I'm going to buy let's see, IBM because it pays a 4% dividend and they like getting that. Now, suddenly when you can loan money to the government for a year, which is about as safe as you can get, and they're going to pay you 4.7, then owning that stock IBM doesn't look as attractive. So typically when short-term rates start to rise, the dividend players.
Wow. So there can be an exodus from the stock equities to the bond market.
Yeah. Yep. Could be. So we've seen a little bit of that here in the fourth quarter. Now the rates have gone up, but people still like that income, and it hasn't been as dramatic as you might think. But it's interesting that the treasury market, it's one of those things where it's like something people in the industry really follow, but people out on the street,
right?
Yeah. And people are more concerned with the borrowing side of it. People are always talking about, mortgage rates, and I'm in a bunch of these, networking groups, and you have the realtors and the mortgage lenders and that there's so much of the economy that's tied to the housing market. So they're always talking about the rates going up. But there is a positive side to rates going up, right? And that's good for savers and investors, or not necessarily good for borrowers. So I think we're just getting back to sort of normal yields. I don't think anybody would consider these high yields or high borrowing rates. Just getting back to some sort of normalcy, which I think is good.
So let me just as the layman's investor
Yeah,
here, if can I keep tagging you with some questions?
sure. Yeah, I'll try to answer them.
So I want to explore the relationship between the bond market and the stock market. Are they uh, they're essentially competing entities for investors, right?
Yeah, and what's interesting is you've had typically when stocks go down, people will fly to bonds for the relative safety. So usually when stocks are down, bonds are up. That hasn't happened this year, and it's when you consider a 50-50 portfolio, it's pretty much been one of the worst years since going back to like the 1930s. So um, in a year when the overall bond market is down 10-11% and the stock market's down close to 20, it's been kind of a painful full year. And the reason for that is you're starting. So remember, bonds work, the price works the opposite of interest rates. So as interest rates go up, the prices of bonds go down, because if you bought a bond a year ago that was paying 1% interest, well, who's going to buy your bond now? Nobody wants to buy your bond now because they can get new bonds that are paying 4.5. So the price of your bond is going to go down. And that's what's happened this year is the new issues have come out paying a higher yield. It's made the previous bonds look less attractive. So bond market's down, stock market's down. But for new money coming into the bond market, it's one of the better times in the last 15 years or so.
Right. And so where do you trade and acquire bonds with your brokerage?
Yeah, so you can do a few different things. You can buy bond exchange traded funds, which trade throughout the day. You can buy bond mutual funds, which trade at the end of the day. If you want to try your hat at individual bonds, you can usually log into your Vanguard, Fidelity, Schwab, TD, whatever, and buy your bonds individually that way, which I think is okay if people are buying treasuries, if they understand what they're doing. When you get into buying corporate or the debt of a company, that can be challenging, and probably should leave that to a professional, especially if you're going out on the risk curve. But yeah, you could buy individual bonds if you know what you're doing through a regular brokerage account.
How did grandma buy me bonds for my birthday every year? How did she do that?
Yes, she'd go to the bank and get savings bonds through the bank usually, or go right up to the teller window.
Is that is that a government bond in the same sense, or is that like a bank product?
Yeah, I mean, there's different. So you had zero coupon bonds, which were efficient, because what would happen is you would buy that bond at $60, and in 15 years it would have a set maturity date of $100. So they always so they didn't pay regular interest, but they just increased in the value. And depending on where interest rates were, if it's in a low interest rate environment, you might be buying it at 70 and it turns into 100. If rates are really high, you might be buying it at 40 and it turns into 100. So that's another thing. Sometimes we run into people who've got these old savings bonds or whatever, and they assume that they're continuing to accrue interest. And a lot of times they've already hit maturity, and that's all they're going to get. So we get those cashed out and whatever. But I don't think people do that as much as they used to. And then of course you could get bonds that pay the coupon, but a lot of them were zero coupon bonds through the bank.
I just keep hearing the term bond matures, collect $100. Is that that was a Monopoly card, I think?
Yeah, Monopoly. Yeah.
That's funny. All right. So last comment about the markets that I'll make. I can't help, and maybe it's because I'm still in the gut of my earning years, but I still can't help but look at a down market as a good thing.
Sure.
What how do you respond to that?
Oh yeah, 100%. I mean, even people that the group I really feel for over the last year or so, and again, it's relative, but if you're somebody who retired a year ago,
Right, you're divesting and exiting, right?
yeah, and suddenly, and you thought bonds were safe, you said, oh, I got my bonds, I got my stocks, and when stocks are down, bonds will be up and whatever. Now suddenly everything you own is down. That can be uncomfortable. But if you're retired at 65, you're not going to spend all your money by 66. So
Right.
you're
Right.
still, I mean,
And you've been
longevity.
investing in the market hopefully for the last 40 years. So you've
Right.
already made you've made hopefully the significant amount of gains, right?
Yeah. Yeah. And that some of the money you have invested at 65 has to last another 40 years maybe. So that's the group, and it's more of a mental thing than a number thing.
Right.
Um,
Your
but
I guess, like, if God forbid you're terminal and you just retired, you have a terminal illness or something, then there are probably individual scenarios for people that may be really uncomfortable in the down market like that.
yeah. Yeah, no, definitely. But even still, I mean, your 60/40 portfolio is, maybe you're down 10-12% this year. It's not the worst thing that's ever happened. So, um,
If you
but
have the proper guidance and advice of a financial planner, right?
yeah, yeah. I mean,
You're not
hopefully,
you're not in a risk profile at 65 years old, right?
right, right. Yeah, I mean, yeah. Everybody's risky until you have a down market, right? So,
Right.
if anything, it's made people readjust. You hope they don't overcorrect and say, this is terrible, I'm never investing in stocks or bonds again, and I'm just going to put it in a savings account at my bank. But yeah, I mean, so young people, it's a good opportunity. They're continuing to buy in each paycheck, and even people who have been. I mean, if you've been retired for 10 years, even with this year, it's been a very good 10 years. Even 5 years, it's been a very good 5 years. So
Well, it's
you,
certainly been a good 2 years, right? Or
yeah,
with the
I mean, well, yeah,
exception of this year.
2020, 2021 were very good years. So,
Right.
in essence, a lot of those gains were pulling returns forward, right? So, which you kind of knew at the time. You knew at some point you'd have to pay the price for those big gains during.
Right. I mean, everybody knew. I mean, not everybody. It seems, I don't know. I'm now approaching 40. I feel like I've now seen a couple booms and busts or
Mhm.
cycles. Or I mean, boom and bust is probably an aggressive terms to use, but really just cycles, right? I mean, they're
Right.
market cycles. What goes up must come down, right? I mean, this is what I've said so many times on the show, where it's just a naturally occurring market is up and down, right?
Yep.
And
Yeah,
what
it's a
and
healthy market, right?
it's right. But yet when we're in the boom, everybody's getting rich, and everybody's got the swagger. But then when the market downturns, I can't. I mean, tell me if you see this too. But in the news, and the media, I would say the mainstream media, if you will, like, does it seem like they're just looking for the villain, right? I mean, is that like everybody's
Oh
looking?
yeah, for sure. Yeah. Yeah, I mean,
Nobody goes like, "Yep, this is a good, healthy function of the market." And if you're still in your earning years, buy the discounts on the way down, right? I mean, that's
yeah, absolutely. I mean, certainly, our favorite news networks and tech and finance networks. I mean, they want the big headline, the big red number. I mean, their
drama.
ratings are better when the market's bad. So, you know, and
But
they
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 just,
have to come up with a headline, which is always funny.
but
Market
there's
down
this sense,
500 today.
yeah. But there's this sense, watching CNBC, like now again at 40, I've been watching CNBC definitely in my periphery in my 20s, but it's been getting closer and closer, to center stage, I guess, in my media viewing over the last 10 years. But now I'm taking my experience in a couple market cycles, and I'm like, you guys don't know what you guys don't know any more than anybody else necessarily. I mean, sure, they may have more data because they're pouring through the data, but when it comes to what the price will be tomorrow or in the next minute or next week, they don't know any more than anybody else.
No, no,
You
and
know?
there's a. Let's see if I can.
And what's fascinating to me, I guess the point I want to make is, Jim Cramer, who has his Mad Money, who is supposed to be one of their experts, like he's made repeated apologies before about getting stock calls wrong. And analysts, I watch a few YouTubers who talk about the markets, and they, YouTubers are funny because they are beholden to no God, and so what they're able to do, and YouTubers are incredibly resourceful, and a couple, I won't mention them, but a couple of them have pointed out and shown clips of where these analysts have been invited to CNBC to talk about a stock on the way up as if they're a subject matter expert. And then when the stock goes down, the show keeps bringing on the next subject matter expert, but they don't mention the person that they had, 3 months ago that was completely wrong in their call today, and I just look at CNBC, for example, and most of those new TV news analysts or TV market analysts, and it's like, you guys, forgive me for saying this, you guys don't know shit.
Yeah.
Or
no, I know, and it's in I guess a little bit of a defense, but not really. I mean, you want analysts who are going to come on and give you that bold prediction, right? I mean, they're in the ratings
the
business.
bold prediction.
Nobody's going to come on and say, well, I expect, IBM to be up 4% in the next 12 months. I mean, nobody cares.
Right.
You need to come on and say, Coinbase is going to double or Coinbase is going to zero. That's what gets rated.
Right.
So I think there's a little bit of pressure on those to bring in the Kathy Woods. I mean, she's a good example of somebody who's become a rock star by, but if you're,
she's a rock star through 2020, but now she's fallen on her face.
Yeah, rock star is probably not the right word. Just a media, it's always
darling,
her fund is up this much or her fund is down. The polarizing figure, I guess, is probably the better.
But I still don't have that energy. Like, I feel like CNBC, if they were being, if they were serving the viewers well from a marketing, from an investing standpoint, I feel like they would be. I feel like there would be more excitement in a down market, because if you're an active investor and you're in the investing cycle, as the market's going down, everybody should be like on a roller coaster, we're going wee, right, and like just acquiring, because as the market's going down, every day you're possessing and acquiring more equities, you're getting it on a discount from it was yesterday.
Right. Yeah, exactly. But the people who watch CNBC are the people with money. The people with money are seeing their accounts go down, and they're in the ratings business, not the investment business. They're in the entertainment business.
But am I completely off on that though?
No, I think you're right.
I mean, to middle America, all of our viewers, all 19 of you, if you're not because I was late to investing, I definitely was, afraid of the markets, and thinking that all these people had this knowledge that I just didn't possess. And then I after, like I said, after witnessing a couple cycles and then starting to get ramp up my investing, I'm like, now every time, and of course that's how I will look at it for the next 20 years while I'm in my investing years. Every time the market goes down, that's where I want to ramp up my acquisitions.
Yeah. No, absolutely. But as we said, they're in the ratings business, and if there's only so many times you can come in and say, keep investing, stay the course. I mean, that'd be very boring programming, I think. But
hopefully I made it look exciting.
You did, absolutely. I was locked in. I was tuned in. So there actually is. It's funny you should mention that. So a plug for an interview that I did a while ago. I had Eric Balchunas on, who is the ETF specialist for. It's probably not his official title, head ETF analyst or whatever for Bloomberg, and he had come out with a book on kind of that subject of boring investing through Vanguard and all that sort of stuff. And one of the things he talked about on his podcast for a lot of years were somebody should come up with an ETF that does what Jim Cramer recommends, and then one that does completely the opposite of what he recommends, either by, shorting the stocks that he's telling you to buy or to go long in. And that's actually out now. There's a short Jim Cramer ETF and a long.
I love it. How are they doing?
ETF. So they are, I don't know if they're launched yet or not. There's SJIM. I'll look that up. I remember there was a lot of talk when they first got registered, but I don't think they're trading yet. I didn't think it was going to happen because they,
I mean, people have, I'm sure, have done historical
oh yeah,
comparisons, right?
yeah,
I wonder how that
um,
compares.
yeah. So no, they're not trading yet, but they have been filed for registration. So there's SGEM, which is short Jim Cramer, and then there's LJIM, which is going to
L-
be long
Long,
Jim
long
Cramer.
jam, yeah.
So anyways, the wacky world of ETFs, which is the good news is if you really want to lock in and invest in a specific area, you can do that now without having to pick which individual stock is going to win in that sector, which I think is good for folks. Like if you had an idea that you thought cybersecurity was going to do really well in 2023, you could buy that cybersecurity ETF or cloud computing or whatever you wanted to do and take a little micro bet on that, which I think is good. But there's been some wacky ETFs that have they come out with these ideas and then they don't really gain traction. And then they end up closing the fund, which happens a lot. But
Right.
overall, most of the advancements in the ETF space, I think, have been good for folks. So, but
Hmm.